Hey everybody, it's John. This is our next GMU Extra. In this episode, we're going to go over the case for follow-through days, and I'll be using a recording that I did back in November of 2022.
So I wanted to get into follow-through days, and I really want to talk about the concept for follow-through days, what are follow-through days, and a few key statistics. So if you're not familiar, follow-through days are a concept created by William O'Neill, and he covers them in his two books, How to Make Money in Stocks and The Successful Investor. So let's go over a page from that book and what are follow-through days and how do they help us? First of all, follow-through days can indicate that the trend is changing back to an uptrend after we've had an 8 to 12% correction, which I would call an intermediate correction. Pretty healthy correction. Follow-through days can help us when things turn back up. And they're also important when we have a bear market and we get a follow-through day, a powerful follow-through day, could be the launch of a new bull market. So I wanted to share an intermediate term correction, as I've shown this chart I used back in January, is 8 to 12%. So that's this kind of orange zone here. Follow-through days are actually pretty a good track record on these types of corrections after they've played out to really renew the uptrend. Now, blue zone is way down here where we are today. I'm going to talk about what all that means. But follow-through days can be used in the context of intermediate corrections as well as bear markets. So what is a follow-through day? And I've taken this diagram, it's page 78 from the Successful Investor book, and let's walk through this, what a follow-through day is. And text below is page 220 from How to Make Money in Stocks. So let's start with that. You can see here, Bill says, starting on the fourth day of an attempted rally, you look for one of the major averages to follow through with a booming gain on higher volume than the day before. This tells you the rally is far more more likely to be real. The most powerful follow-through days usually occur on days 4 to 7 of the rally. And it goes on to talk about the 1980 bottom, which is actually this diagram to the right. So let's look at this closely. As the market has come down, it's declining, and it's starting to make new lows. At some point, the market will rally. And the note says the first day of a rally attempt is the intraday low, it's a support level for the attempted rally is established. So if we take this first day, this is first day of the rally, and if the low is undercut, then the rally fails. Now, in this case, Bill's showing that here on day 2, the rally fails because we undercut the low, which is this dotted line. So we undercut, so that negates that rally attempt. Then we get another new low, and then we get this day right here. We begin counting again here. First day of the rally attempt. Index closes up. We only start counting a rally if the close is up from the prior day. So this number 1 is showing this day here has a close higher than this day. So that's day 1 of the rally attempt. You can see that we have day 2, the index is up. Second day, it's down a little bit. Third day, it's an inside day. You can see day 4 is slightly higher. And the note is the second, third, and fourth consecutive days of the rally attempt. As long as these days stay above the initial low, this line, above the first rally day, you're still in the rally process. You'll notice after day 4, we get day 5. Now, day 5 is the follow-through day because the index is up 1% or more, increased volume from the day before. And the market is, quote, in a new uptrend. It usually occurs the 4th through the 7th day of an attempted rally. So that's the schematic of what a follow-through day is when you lay it out on a diagram. So let's go into the concept of follow-through days. We mentioned that intermediate corrections, they have a pretty good track record, but we also know that in bear markets, the success of follow-through days is not as good. And I know there's a lot of people that are getting very frustrated that we've had multiple follow-through days that fail, and they're starting to doubt the entire concept. So I wanted to spend some time to put it in perspective of why do we keep putting our toe in the water when we have follow-through days. So a follow-through day, and Bill's book was written back in 98. Again, we're looking for day 4 or later, a minimum, this is a minimum, 1.25% gain on greater volume than the previous day. And we're talking primarily about the S&P or the NASDAQ. Now, all the follow-through days don't work. There's no guarantee. But it's important to note that no bull market has ever started without a follow-through day. That's really, really important. That's why we pay attention to these, even if they don't work. As I mentioned, there's a higher success rate, approximately 75 to 80% of follow-through days will work after an intermediate term correction. We have a pretty good pullback, wash out a lot of people who get a follow-through day. We can get resumption of a trend, particularly if we're already in a bull market trend. Now, we know that the follow-through days have a lower success rate in major bear markets. Major bear markets meaning at least 30% plus decline. Now, the best follow-through days after a bear market are really between days 4 through 10. And you want bigger volume than average if you can get it. And rather than the 1.25, we'd love to see gains, price gains of 3%, 4%, 5%. The follow-through day that kicked off the 2020 bull market was a 7% gain for the NASDAQ on April 6th. So the more volume and the more gain, the more convincing it is, particularly if stocks are setting up. So I thought it might be good to run kind of a simulation about why are we putting our toe in the water? So in this simulation, what we're going to do is set up some guidelines. Here are the rules. We will initiate 3 positions on the follow-through day, and we will control the risk to 1% of account equity on each position. So if all 3 positions get stopped out, we will have lost 3% of our account value. Now, after 4 follow-through days, we're likely in a deeper bear market, so we will only take 2 positions on the follow-through day, and we will tighten our risk controls to have risk controlled at a half of account equity. So we'll be reducing some of the volatility in the account. So in this example, we're going to assume that our account peak equity was $105,500. And we will assume the normal process of correcting off the top was 5%. And it leaves us with a starting account value of about $100,000 as we start to go through a correction. So in this case, follow through day number 1, start with $100,000. We've risked 1% for the 3 positions. We have 3 positions. So if we get all stopped out, we would lose $3,000, leaving us with account capital, $97,000. And for reference, to get back to our starting capital, we would need 3.1% gains on this capital to get back up to where we were, and 8.8 to get back up to where we were at the absolute equity peak. So follow through day number 1. Now, let's assume the first follow-through day fails, and we follow the same process. We get another follow-through day. Now we have $97,000. All 3 positions are stopped out again, and you can see these numbers. Then we have a third follow-through day. Following the simulation, we take our 3 positions. They all get stopped out. And now we have account capital that's drawn down to $91,267. Now, it's important, follow through day number 3 in this example, and I'm showing you, this is the 98 bear market, and this is the important part of this exercise. When the 98 bear market got the follow-through day that worked, which was follow-through day number 3, the NASDAQ went on a tear. It went up 87%. And we can make an assumption that growth stocks, if you're in the right growth stocks, you have potential gains of 174%, which is double what the index gains. Similarly, in 2018, we had a 3-month bear market, and it took the 3rd follow-through day to work. At that time, the NASDAQ ran 32%, so you can see you potentially could have been in growth stocks to make 64% gains. This is the reason why we put our toe in the water on follow-through days. Now let's assume that we go deeper, and we'll look at that in a moment, but I wanted to just show you 98, 2018. So here's 98, sharp 3-month correction, bear market 33% in 3 months. We get a very strong follow through day, 2.1%. And I've noted when stocks broke out, and look at the power of this rally. Really, really unencumbered up. You can see multiple ensuing follow through days on the way up. That was a very powerful rally in 98. And a very similar blueprint happened in 2018. Again, it was a sharp bear market. We were down over quite a bit in 3 months. And then you can see here, we had a very strong follow through day on January 4th. The NASDAQ was up 4.3%, with the S&P up 3.4%. And we had multiple subsequent follow through days. And you can see it's almost a straight line up. And there's the scattering of stocks that broke out and that rally. So getting back to our simulation, let's assume that follow through day number 4 were to fail. And now we are getting into what I would call deep bear market territory, when you have at least 4 follow through days that have failed. So at this point in our simulation, our account capital is down to 88,529. And we now have decided that we're only going to take 2 positions and risk 0.5% of our equity. So we'll assume we get stopped out again on follow through day number 5. Okay. Now, if follow through day number 5 was to work, as it did in 1982, subsequent to that follow through day in 82, the S&P ran 73%. And if you were a growth stock investor, you could have been potentially looking at gains double that of 146%. This is what that looked like. The NASDAQ's bottom in August of 82. You can see follow through day. There's some of the stocks that were breaking out, and a very, very powerful rally off the lows, which launched a major, major bear market. So back to our simulation. Let's assume the bear market is very bad, and we're getting deeper. Follow through day number 6 fails. You can see where we are in our capital, what it would take to get back to our starting capital. Sorry, these should all be positive numbers, rather like these, positive numbers to get back to your starting capital. Follow through day number 6 fails, follow through day number 7 fails, and now we're really into major historic bear markets. So follow through day number 8 was the one that worked in the 2009 market. So again, at that point, follow through number 8, following our rules, we would have been 17.6% drawdown. That, really, really feels bad at the time, but we're still within striking distance of our old highs. And that's important. And we're trying to control risk, but we also want to make sure that we put our toe in the water on these follow-through days. So follow-through day 8 actually was the one that worked. And you can see here, the NASDAQ went on an 84% run, and we ended up, if you're a growth stock investor, potentially 168% gains. That's what makes it worthwhile to keep putting your toe in the water. And if we get down to one of the worst bear markets ever, is 1974, where we had 9 failed follow-through days before we got number 10, which actually worked. And if you were just afraid to buy that follow-through day, you missed out, because the S&P ran 60% rally, which is, again, double that, 120% potential gains if you're in growth stocks. So I tried to demonstrate here that even though we are trying to control risk, we don't want a huge drawdown, and some of these drawdowns may be acceptable to you, they may not, and you can change your own parameters. But the point is, you don't want to miss all this colorful stuff to the right. This is where the potential is. So if you can have small nicks to your equity and still stay in the game, you have the potential to really get a toehold in some of the new leadership. So it can be frustrating. It certainly is frustrating in this particular bear market. But let's go forward and look at where we are. Before we do that, here's the 2009 rally. Here's where the follow-through day occurred. And again, here are the names that actually broke out and some of the runs they went on. Look at the runs, 500%, 400%, 300%. These are big, big runs. And you only can get these gains if you are on the spot, doing your homework, and prepared and mentally are prepared to put your toe in the water on a follow-through day. Here's the bear market in 73, 74. Here are the 9 failed follow-through days. And finally, follow-through day number 10 was the one that worked and led to a 60% run in the S&P. So snapshot to today. Here we are in the 2022 market. This is the NASDAQ, and we are still working on follow-through day number 7. We had a follow-through day here. We undercut the low of that follow-through day, which was not a good sign, but we did hold the low of the rally attempt. So it's still alive. And then we got a follow-through day subsequent to that, which was really strong, of 7.3%. So this follow-through day is actually still alive.
So hopefully that was helpful to you to understand the case for follow-through days. They're pretty important, and hopefully this has convinced you to put your toe in the water when we get a follow-through day. That's the GMU Extra for this week. Thanks, and we'll look forward to seeing you at the next one.